Hey everyone, John Lee here. Today we're going to have an honest, candid, and open discussion about exactly what is going on with the market right now. There's stimulus packages on the way, but we want to figure out what that means for you as the average consumer. And I'm not trying to get you to smash the like button. No, I'm not trying to get you to smash the panic button and to scare you. That's not the purpose of the video. I really want to take a logical, realistic approach for us to analyze what's happened in the past, because history tends to repeat itself. We'll analyze and go in depth of what exactly happened in the stock market in the United States for the last 100 years. Based off that, we'll see patterns that we recognize, and we'll be able to better strategize and prepare for what's up and coming. Once again, my name is John, also known as the Property Shark, and thank you so much for tuning in and watching my channel again. And right off the bat, we're gonna get right into it. So I'm that type of person that really tends to overthink. I mean, I think about the possible worst case scenarios of everything, especially the last couple of days. My clicker is constantly on that refresh button on major news sites, CNN, CBC, also on Google stocks, just to keep up to date with exactly what's going on with the stock market. And that's okay. But really, I just want you to know that it's okay to be scared, and it's okay to not know, and it's okay for you to be worried, because this is what we call it. This is what people call the black swan effect, where nothing like this has ever happened in the past before. This is unprecedented. This is unheard of. So when you have a black swan event, really no one can prepare for it. So I just want you to know that, if you're a viewer out there and you're panicking, hey, that's totally cool. I'm freaking out. I have friends calling me up, John, what should I do? How much should I save up? Asking me questions like that. So it's okay to panic, but I really wanted to have an open discussion, be realistic, be logical. So let's look at exactly what happened in the past 100 years, 110 years in history of the United States stock market. Based off that, let's look at some patterns. And after we summarize everything, I want to give you my own thoughts of some possible scenarios and how to best prepare yourself for this. Now, okay, so there's a lot of information I have to go through with you guys here, but let's get into it. I'm not going to cut any of this out, all right? This is just raw. This is me. This is my heart, blood, sweat, and tears pouring into it. So give me that, smash that like button. Give me a little bit of support and love here. Really have a lot of great information for you guys. So let's backtrack to what happened a couple weeks ago, right? So things were going fine. Even on February 19th, S&P hit a new high of 3,386 points. Unemployment rate was low. Interest rates were low. And we started to see a little bit of this illness spreading in China, in Wuhan. No one was really panicking. No one was really doing anything until it started spreading rapidly. So, once it got to Japan, once it got to Korea, and even took over a whole cruise ship, people started to realize the severity of this illness. And like I said, it's called a black swan effect because no one was really ever prepared for it. No one really saw it coming. The virus posed a huge threat to the global economy, but also the health and safety of not only ourselves but our loved ones. Again, just want to remind you all that it's super important that we do our part, and we practice #social distancing. We do our part in helping flatten the curve, because without any symptoms being discovered, when you contract this virus, you can unknowingly affect a lot of people, especially the ones with weaker immune systems or the ones that are more elderly or even your closest loved ones. So it's absolutely critical. If you guys can't stay indoors, watch more YouTube videos like this, smash the like button, and to help boost the YouTube algorithm and do your part really in helping contain this virus, because the more we can do our part in helping it out, the more people that stay inside, the quicker we can resolve this issue, the quicker we can contain this virus, and that means the better for all of us, right? So keep that in mind. So initially the illness began to spread, and the federal government lowered the interest rates, and even in Canada we saw that too. The Bank of Canada dropped the interest rate by 50 basis points, and then they dropped it later 2 weeks after when following the Feds, because the Feds they reduced the interest rate close to 0% because of what's been going on in the pandemic. So essentially, when the interest rates drop, usually that's a really good sign for investors, because it means that you can borrow money at a cheaper cost. But instead of doing the boosting the economy, it actually the stock market took a downward nosedive. People actually panicked, and they start to think, what's going on? There's this illness that's kind of spreading around. We don't really know too much about it. What did the Feds know that we don't, and why are they dropping interest rates all of a sudden? Again, people panic, they freak the F out, and the stock market just kept on correcting down because people are not confident in it. And from an investment standpoint, as an investor, the illness brought to the surface a lot of things. Again, the economy, and I'm sure a lot of other nations, other countries were not prepared for as well, for this big illness and this big virus. It's a pandemic, and even the healthcare system in the United States and Canada cannot possibly hold so many patients at once, right? So that's a big issue too, because we're not designed to take an influx of patients all of a sudden. We have limited supply of healthcare equipment, also healthcare workers. That, again, shout out to the doctors, the nurses, everyone on the front line fighting this virus. My hat goes off to you, and thank you for everything that you do. But really, our healthcare system is not designed to handle so many people. So the best way for any country really is to practice social distancing, to really stay at home, to avoid unnecessary human-to-human contact, because then that would prevent the illness from spreading. And we've seen lockdowns being in place. We've seen businesses that are not really important have to limit their hours or shut down, and people don't leave their house. So when that happens, when businesses close down or they reduce hours, and people have to stay at home, guess what? People don't go out. When people don't go out, they don't spend money. And at the same time, a lot of businesses can't keep afloat because the government has requested that that they shut down, and they don't have income coming in that way. So it creates a ripple effect throughout the economy, and it actually impacts a lot of people all along the chain, the supply chain of the economy. And again, as promised, to help with all this, there are stimulus packages that have been proposed, and I think it's still being stuck at Senate, as far as my understanding. In the United States and Canada, they are in talks to pass an emergency bill, I think tomorrow on Tuesday. I might be wrong on that, but essentially in the United States, the talks have stalled, and it's up to like $6 trillion that of an emergency fund that they're going to try to pump that back into the market to try to revive it. But again, who knows what could happen then, right? With that being said, a lot of travel restrictions, borders are shutting off, airlines, flights are being canceled. Not only that, interest rates are lowered again, and there's a lot of uncertainty, right? So like I said, in times like this, history tends to repeat itself. So as an investor, as an individual, I want to kind of review and recap, what's kind of been going on in the past 100 years in the stock market, see if I can pick up any trends, any strategies, any tips for me to then apply to a situation like a pandemic, and a situation in the markets like today. So without further ado, let's go for a quick history lesson of exactly what happened with the stock market in the United States, starting with 1907. So that's when the San Francisco earthquake happened. Actually happened in 1906. So essentially the stock market corrected and it dropped by about 50%. And the reason for that, due to the earthquake, there are a lot of damages to personal belongings, to structures, things of that. There was a lot of insurance payouts. Because of that, people started panicking. They withdrew a lot of gold from the banks. Because of that, the banks and the feds, they tightened the lending regulation. People panic even more because now there's restrictions on money that can be withdrawn from the bank. So when that happens, guess what? People get even more scared and they just go withdraw more money because they're like, man, this money, this cash ain't liquid. I need to take this money out. What if my money gets stuck in there and the banks, they default and I can't get my money back? So people kept on taking the money out, and really that led to the monetary policies that we have nowadays, and the Federal Reserve, came about because of that. So long story short, people regained confidence in the economy again, and they saw a 193% increase in price within less than 4 years. So this is going to be a recurring theme that I want you guys to watch out for in terms of, how much it dropped, how much it picked up, and then we'll get into that later. Boom. Next thing that happened is the Roaring 20s. So 1920s, because of the tremendous growth in the financial markets that carried from 1907 and onward, people just became so confident in the markets, and they're like, well, the stock market can only keep on going up, right? So guess what? People started over leveraging and lending out ridiculous amounts of money to pour that back into the stock market. And the Federal Reserves did their part. They issued a warning, but obviously a lot of people herd mentality. They don't listen. And I guess part of the problem was the banks were lending money to anyone walking in that wanted to borrow a large lump sum of money. The banks would lend out to them, no questions asked. And that was a big issue. And because the stock markets don't go up, they go up and down. I'm sure anyone could, and people would know that, but apparently I thought people know better, but apparently they don't. So essentially what happened, the people panicked and had less confidence in the stock market. Interest rates went up, and I think that could be a big reason as to why the stock market crashed in the 1920s, but really there is no accurate answer. Some other people say that could be the agricultural companies. They overproduced and they had to sell at a loss essentially, and that triggered a lot of the other businesses that go along with it. And when people panic and they lose confidence in the market, you'll see the market correct. So when that happens, again, people withdrew money like crazy because they're scared that the banks would go out of business. And the funny part here is the banks loaned out so much money that they didn't really have enough money to give it back to the people that lent them that money and saved the money in the bank. So because the banks had no money, the stock market took a hit, dropped 83% in over 2.8 years. Unemployment rate increased to 25%, which is really high. A lot of people still had no jobs at that point when this all happened. And then World War II came along, and many would argue that World War II actually helped people get out of helped the United States get out of the Great Depression. Something like 17 million people who didn't have jobs suddenly were now employed. And from that, that particular point onwards, there was 14 years of just ridiculous amounts of growth. The financial market increased by 815%, and the war ended, and a lot of veterans came back. So about in 1945, there was a 22% drop in the stock market because there was an influx of veterans coming home from abroad, and they were kind of competing with the limited amount of job opportunities available. But after that drop, again, 15 years of growth of 935.8%. So, we're seeing a recurring pattern here that, people panic, people take money out of the banks, stock market drops, and then, we'll experience tremendous amounts of growth, tremendous amounts of increase in the financial markets as well that follows. Next event, 1974 was a turbulent time. And that's when the stock market lost 40% of its value. This is when President Nixon, you guys might still remember President Nixon, they announced that they're taking the dollar off the gold standard, meaning that the United States dollars is not correlated with the gold, or the price of gold, I should say. And that led to crazy inflation because essentially there was already money circulating, in the economy. But all of a sudden, once this standard is removed, they started printing out more money. There was an influx of money in the market, and that led to ridiculous amounts of inflations, and the government tried to counter that by increasing the interest rates to keep the dollar, to keep the market in check, the money in check. And so from that point on, the stock markets, again, they climbed 13 years of 835% growth. Next, we have the dot-com frenzy in 2001. So again, this is from speculation, something that we've kind of seen more recently, 2017, 2018, in the speculation of cryptocurrencies. Essentially what happened in 2000, 2001, people were buying like internet companies like crazy because the internet is the internet, it's the future. So all these companies are going to make ridiculous amounts of money, and people were wrong. And people were buying internet related companies without really going over the right technical analysis, going over the chart analysis, going over the company statements and whatnot. And unfortunately, a lot of these companies were unsustainable because once the funding ran out and they couldn't sustain themselves and start making a profit, a lot of these companies went out of business. And the stock market dropped 44%. Eventually, the market rebounded again. We saw a 5-year growth of 110%. And that takes us to the last most recent event in 2008, 2009. I'm sure you guys still remember the Great Recession of 2008, 09. Probably don't need to get too much in depth. I mean, there's a movie on it. What's that movie called again? It's called... I forgot what that movie is called. Let me look it up. Okay, yeah, there you go. It's called The Big Short. So for all of you guys that want more information on exactly what happened, The Big Short is a great movie to watch. But essentially what happened, again, people were borrowing ridiculous amounts of money from the banks. The banks didn't have the right screening or precautionary steps in place to qualify these people to see if they can actually pay back the money. So banks lent too much money out to people. People took the money, started buying homes. Eventually, a lot of people, they couldn't come up with enough of the payments. So because they're not qualified to buy a home, they don't have the right income or qualifications in place for that. So essentially, a lot of people, they bought a house, they took on a mortgage, they couldn't pay the mortgage, and then the property defaulted back on the banks. And essentially when that happens, the stock market dropped by 50%. Federal Reserve did step in to bail them out. I think about $733 billion to bail out these companies and to help the economy. But from that point on, we've seen a ridiculous, tremendous amount of growth in the market. This bull run has been going on since '09 up until now, and it's nothing that we've ever seen in the history of the United States stock market. So hey, we've seen a ridiculous amount of growth, and from that point on, it's like, if this virus and illness didn't spread, it'll definitely it would be safe to say a lot of people are assuming that the stock market would just continue to grow, economy will just continue to thrive, and everything would be all good. But with this virus in place, we really don't know how long it's going to take for this situation to be resolved. Now, one thing to note is, historically speaking, in the past 110 years, every time the stock market corrects because of an event or a frenzy or uncertainty, people lose confidence. People do eventually gain confidence back, and the stock market would, run for a couple of years and gain massive amounts of profits. But so what I'm trying to say is everything will be okay eventually, but we just don't know how long this process is going to take. And this is a global pandemic that a lot of countries are affected, that we've never seen anything this big on this big of a scale. I mean, even dating back to SARS 2003, 2004, SARS was more contained in certain parts of the world, more so in the Asian countries, I would say. So that really didn't have this great of an effect on a global scale. But at the same time, with that being said, we really don't know currently, right now, how worse or how much better the situation can really become. We know for a fact that a lot of these small businesses, they go paycheck by paycheck, and there's really only so much time that they can keep their doors shut, before they have to close the whole store down, because they can't keep themselves afloat, unfortunately. So I do see that a lot of businesses are going to go out of business. People are going to start losing jobs, and at the same time, people are going to have less money to spend, so they're going to cut back on spending. And obviously, with that being said, people are not going to go out and buy stuff or spend their money, and that affects the companies that are providing these entertainment services or providing goods or services, and there's a downward spiraling, trickling effect, that impacts the whole economy. And the good news is there are financial stimulus packages on the way of somewhat of like $6 or $7 trillion. It's being stalled at Senate, but they're trying their best to pass that. And who knows what that stimulus package will do or how it will affect the market. Will it be a little bit too late? Will it give it a boost for a short period of time, and then we see the market correct down? It's really hard to say what the effect of that is until it rolls out. So I think what we really have to be careful here is, regardless of the financial outcome, health is so important. Again, you want to make sure you do your part to practice social distancing to help flatten the curve. You don't know if you're going to contract it because it shows no symptoms, and then you could really spread this virus to other people. And for people that have a weaker immune system, they are going to be the most affected by it. Also want to do our part in helping out our doctors, our nurses, all of our healthcare workers that are at the front line battlefield with this virus. Thank you so much for everything that you do and your continuous support. So guys, seriously, help your friends and family out. Look after your loved ones, give them a call, make sure people are okay. If you have family across the world, check up on them, make sure they're okay. Remind them to stay indoors, do their part to help everyone out, because the sooner we can contain this virus, the better it will be for everyone. Now, in spite of what's going on, let's talk about my thoughts and the possible of such scenarios that could occur. People do their part in staying indoors, staying quarantined. They help flatten out the curve. People recover, confidence in the market skyrockets and resumes. Vaccines are offered, and businesses begin to open their doors again, consumers start spending money, and after a few lost quarters, we will see the economy go back to normal and continue the growth and eventually recover. So that's the first scenario, is more of like a short to the point, okay, boom, the market would pick up again. And then the second possible scenario is, this is gonna last way too long than people think. People are gonna be out of jobs for a way longer period than they expect. Healthcare system will be continuously overwhelmed to a point where they're at overcapacity, and they're unable to do their part in containing the virus, so it spreads even more rapidly. That could happen. With that said, people's confidence in the market will definitely go down even further. It'll just be a domino effect, and continue to drop the prices of the market. So to be completely honest with you though, like, no one really knows what's gonna happen, exactly how this thing is gonna play out. And in theory, people were saying that the stock market was doing so well. I mean, we had a great bull run since the last Great Recession, that if this virus or this illness didn't come about, we would continue to experience tremendous amounts of growth. And I would agree with that. And so I think the variable here is the virus and the illness itself, the coronavirus. So if we can find a way to contain it, to really mitigate the impact it has on humanity, on society, then if we can effectively do that in a shorter period of time, I think the stock market would reflect that. However, if it takes a longer period of time before it fully adjusts, then obviously the stock market would correct accordingly as well. So yeah, it really depends on this variable, this coronavirus thing, depending on how we resolve that and how soon we can resolve that, and that would dictate how long it'll take for the whole market, the economy to recover. And the whole point of this video here is not to scare you, okay? So I'm not trying to be here to be Debbie Downer, to really bring you down, the world is ending. No, that's not my goal. The goal of this video is to just take a step back, be logical about it, be realistic about the situation, have an honest and open conversation with all of you guys. Again, if you're watching, thank you so much for watching. I really appreciate from the bottom of my heart that you're watching this still. But the point is to keep you guys informed, keep you guys educated. And from the past 100 years, after every certain point in time when the market dropped, we've experienced years of tremendous growth. Sometimes even 835% of growth over 5-10 years. So that just goes to show how resilient the market really is, and eventually everything will be fine, everything will recover. But with that being said, it's okay to panic. I mean, after all, we're all humans, we have emotions, we experience emotions in a time like this where there's a high amount of uncertainty. A lot of people are freaking out, a lot of people are scared. I totally get that. Embrace that. Really try to find a way to, if you're bothered by this, to educate yourself. That's why I took some time to make this video, to educate yourself on this topic. If you're scared about the implications of the financial market crashing, well, hey, why don't you look at the history, because history tends to repeat itself, and look at some past trends, and based off that, you can plan out your strategy ahead. So I just want to wrap it up to say, on a side note, again, please help with the social distancing. Please help flatten the curve. Do your part in helping your country, helping the global society, helping the economy. The sooner we can do our part to help this thing and contain it, the greater it will be for all of us. And don't forget to smash that like button if you found tremendous amounts of value. I really appreciate you guys for watching. Thank you so much. If you have any questions, definitely feel free to drop it down below. Don't forget to destroy the notification bell. What navigation? Destroy the notification bell. Destroy that subscribe button. And follow me on social media at The Property Shark. I post there every day as well. So yeah, thank you again for watching. And we'll see you very soon. Take care.